Hey, good morning, traders and investors. Todd here with Trading Analysis. Hope you guys are well. Welcome to the Wednesday live stream, the last one in April, right in the middle of earnings season. Good earnings so far. Fun market as always, and I hope you guys are doing well. So we got a big show for you, as we do every Wednesday. We've got Alex, Terry, Bennett standing by. So let's kind of just open it up here. We're in the middle of the biggest earnings week of the year, and we saw some really good earnings. Not seeing quite the response that I would expect. We had Google, Microsoft, Starbucks, AMD, and others last night. And even I think earnings are certainly important, but I think that the predominant headline, which is what I want to start with now, and what everyone's talking about is inflation. And I've been tweeting quite a bit about, what this means and how bond markets are a good indicator of, where we are exactly. And there's so many people who are convinced that inflation is here, and we're starting to see it manifest in the bond market, the U.S. Treasury market, and we'll kind of dive into that a little bit and explain what that means. Inflation is something that we've been told is imminent and going to be on our doorstep for the last decade. We haven't quite seen it. We're seeing glimpses of it. Is it really here? Is it going to become a sustained problem? So we'll look at that quickly. Earnings, of course. We have a couple trades going on here at Trading Analysis. We'll show you that. What else? Still studying I picked up another book. I didn't like the other book I was reading, so I'm starting again for the Series 65, which is required for the money management business. That's still on track. So lots happening. All's well. Personal note, I'm now 9 days out of ACL surgery. I had total ACL reconstruction. I had a problem with my meniscus, LCL and MCL and ACL. So everything was screwed up and feeling fine. So I don't know if you guys have ever had it before, but there's a few different ways they can do it. They can take, I've got my brace on underneath here. So they could take your quad, your hamstring, or your patella tendon. I don't know if you can see all the bruises and bandages there, but they took my quad tendon. They took like this much of my quad tendon, cut it out, and then drilled into my ACL, and cut in my ACL and drilled, I guess, my femur and maybe tibia and fibia, screwed them in and created a new ACL. So I thought it'd be down and out for a while, but I'm feeling pretty good. I mean, I cannot, crutches are gone. I can dance around. I can stand on one foot. I'm feeling okay. Pretty amazing. So that's that. I was on some dopey meds for a while, and I couldn't wait to kick those. That oxycodone, I know that crap is something you don't want to mess with. So after 2 days, I cut that out, and I've been fine. So that's that. Other than that, we're good. So let's dive into some charts. I tweeted something, and I am going to show you lumber futures here. You guys heard about this? Holy bananas. Out of control. I tweeted something a couple days ago, and I was kind of trying to stir the Twitter pot a little bit and get people a little riled up. And it's, as I said, the one thing that we're constantly hearing about is inflation, and inflation is here, which a corollary to that is that the bond market uptrend is over. Okay. And just to review, I'm sure you guys know this, but as bond prices, this is the US 30-year Treasury. I'm sure you know this, but it's really important to understand, especially as stock market investors and traders. You've got to understand what the relationship of expected inflation, deflation, stagflation, the resulting impact on the bond market, and then what that does to the stock market. It's really important. So as bond prices go up, they're paying a fixed dollar coupon amount. And as the price of the bond goes up, that fixed dollar, let's say it's $100 a year, whatever, the price, or the percent, the 100 represents of an increasing bond price, that percentage goes down. So 100 as a percent of $1,000 face value is at 10%. If it goes up to $1,100, the bond goes to $1,200, $1,300, $1,400, $1,500. That 100 becomes a smaller percent, and that's how interest rates work. So if you look at this 30-year bond chart, this market's been going up since pretty much I've been out of diapers, going to be honest with you. I think the uptrend, I mean, it's kind of subjective. The uptrend in the U.S. Treasury market started in the very early 80s. I was born in 79, so was my daughter's age. And I just find it interesting, guys, that so many people in this new digital information, stay-at-home COVID age, everyone's grasping for your attention, trying to scare. But I'm just shocked by how many market professionals are declaring, one, that inflation is finally here, which they've been telling us this since I was trading for a foreign exchange hedge fund on Wall Street in 2008, when they started the first edition of QE. They told us inflation would be rampant, out of control, and destroy the US dollar. They've been telling us that now for 13 years. Is it finally here with all this unprecedented stimulus packages from the government based on COVID? Maybe. But there's a lot of people pounding the table saying inflation is here. It's going to destroy the dollar. The Fed's going to have to raise rates. They don't have any choice. It's going to choke off the stock market. Maybe. Let's take a look. So if you look at this 30-year bond market, like, okay, I don't know how to draw trend lines, guys. I've only been doing this business for 20 years. I don't know the right way to draw a trend line. If you do, please let me know. But I'd say let's take, the low here, try to connect that guy. Let's take the low here, connect, low here, low here, low here, low here, low here. I got 7 different possible trend lines. If you see another one, probably. I don't even see the slightest bit of evidence that an uptrend in the bond market is broken. Not even close. And this is why I love understanding fundamentals, but being fairly competent in technicals, is this drop down in the bond market is what people are saying, oh, that's it. 38-year, 40-year uptrend bonds, it's done. Cash it in, short them. It's it. I don't know about you, but why is this sell-off different than this sell-off, than this sell-off, than this sell-off, than this sell-off, this one, this one, this one, this? You get my point. In fact, if you want to be real, I would say so far, if we did a percent change, which we can do, take a net percent from 190 to 158. So what is that? Roughly 30 points as a percent of 190. So 15-ish% decline. I don't think it's anything larger than anything we've really seen, any significant correction. So I just say, guys, like, there's so many, knock-on effects with the fall in bonds. And if we are truly going to break a 4-decade uptrend, okay, maybe we should start testing some uptrend support here, which would certainly put rates, 3, 4, 5% on the 10s and 30s up in that range. Then we can start talking about a how do I say this? A valid test of uptrend, and then you can start trying to scare people. Okay, so I really wanted to draw that back, and then and somebody pushed back on Twitter, which I think was valid. They're like, "Well, Todd, you need at least 3 or 4 swing points for a trend line." Okay, fine. I mean, whatever. The point remains, guys, that this is the channel I've been watching in the entirety of my career as an investor and trader. Guys, bonds have been going up since I've been walking this earth, and probably most of you, if you're in your 50s and 60s, you have seen falling bonds, increasing rates in the 70s. But while this uptrend channel, I don't care how you draw the trend line, while this uptrend channel is intact, I say the bond market is still in an uptrend. Okay, I've said this multiple times. I'm not going to waste too much time here. I want to bring the TA team in real quick. I want to show you some economic data that we're coming up on. There's 2 massive deflationary forces, not massive. There's 2 steady deflationary forces that are keeping the uptrend intact, which is investors' lifespan is longer. There's a longer demand for yield. So there will be a more consistent buyer of fixed income as investors' age is getting longer, and technology is increasing the operating efficiency of a lot of companies, changing the way we work, displacing more jobs, making companies more efficient, which is inherently deflationary as prices are falling. Okay. So that's that. We are watching inflation data here, and I have some data ready for you. There's two main gauges of inflation. There's CPI and PCE, personal consumption expenditure deflator, which is the Fed's preferred gauge. And I'll show you this here real quick. There's an interesting sort of split going on right now here between CPI, which saw a pretty big move up to 2.6% year over year. The Fed's changed their status where they say, okay, we once we get above 2%, we'll begin to sort of become less accommodative, and we'll perhaps ease off the 160 billion in asset purchases they're doing, and maybe start to talk about raising rates. Now they want to tolerate extended levels of inflation above 2%. We're at 2.6% now, and just to kind of back out here a little bit, kind of get the view, you can see that inflation has been in a downtrend for a long time. So yeah, we're pushing up against 2.6% year over year, but this is the CPI. The preferred inflation gauge is PCE, which is right here. All right, if you take a look at this guy, US PCE price index year over year, we're only at 1.55%. So you saw a 2.6% reading in CPI, but a 1.55% in PCE. This right here, I think this kind of divergence between the two is enough to certainly leave the Fed on hold. And that's, we have a Fed meeting coming up here, which nothing is going to happen. I think Jerome Powell's acknowledged the faster recovery. Maybe he'll talk about corporate health here that we've seen thus far in earnings season, but guys, this is 1.55% on the PCE price index year over year is nowhere near the point where the Fed is going to start getting concerned. Okay. And again, you just look at where this is. This is a long way before we even begin to break the downtrend of falling price levels. Okay. So we have another round of stimulus checks coming up. Is this truly a inflationary force that the government has put so much money out there in the market? They're bidding up Dogecoin and all these altcoins that Alex is going to talk about. And is it going to the stock market? Perhaps. Or is it the other side where as COVID hit, a lot of companies and a lot of companies kind of tooled down, kind of pulled in their operations. They didn't quite realize that the economy, in fact, was going to explode post-COVID. And I'm going to sneeze. Excuse me. Speaking of, is that bad to sneeze when you say COVID? Fully vaccinated. Thank you, Pfizer, right there. Are you guys vaccinated? Let me know where you are in that process, or if you're going to get vaccinated. So I think it's more of a supply issue. There's a demand side, but also I think there's a supply side as well. I think a lot of companies just pulled in their operations with COVID, and then didn't quite realize that COVID was going to spark this technological, accelerate this technological boom that we were in pre-COVID. It was just going to accelerate it even faster. Then companies said, oh God, we went the other way. We didn't need to ramp down. We needed to ramp up. So I think it's more of a supply side. You look at all the semiconductors that's going on. You look at shortages in semis and lumber, and you look at housing prices, and this move from the cities out to the rural areas and suburban is real. So I think supply side needs to catch up, and I think that's a lot of what we're seeing on the inflation side, and earnings have been good. We're in a strong bull market. I don't see evidence of inflation becoming rampant. I think there's too many people trying to pound the table, scaring you, just trying to grab your attention, because that's what we're in right now. We're in a digital information age where everyone's trying to grab your attention. And speaking of your attention, thank you for joining us. I know there's a lot of content out there. So I'm still bullish. I like where we're at. I'm still very long. And I don't see any reason to change. We've made a lot of money being long stocks, and I say don't let them scare you out. So let's bring in the TA team. Let's see what's going on with those guys. My guys, boys, what's up?
Good morning, Todd.
Morning, Todd.
How's it going,
Hey,
guys?
good morning, man.
Doing
Thoughts?
good, doing good. Just we've got the Fed this afternoon, keeping our eyes on that.
Yep. 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 What do you guys think? Thoughts, feedback? Jump in there.
Yeah, I mean, regarding your inflation observation regarding Fed, I think Jerome Powell will do exactly the same as you told today, but June might be problematic, or July, where is the next Fed meeting. So in general, if you see today, 10 years are going a little bit on the upside. 1.7 to 2% will be a huge resistance, but if we cross that on the upside, technically, we might jump there. But in any case, if we get any inflationary pressures, I think they're going to be transitory until the economy balances itself. So that's kind of how I see it.
Yeah. And it's interesting too. There's, just on the supply side, I think in today's day and age, and as competitive as this global economy is, how are we really constrained on the supply side? If the buyers are there, the demand is there, and companies can make money. I mean, God, I have such a hard time seeing that supply just isn't there. I mean, listen, Global Foundries is a semiconductor company. They have a big location right close to me here in Saratoga Springs, and I know they're trying to ramp up. And I know Biden's infrastructure plan is earmarking a lot of money for semis, and Bennett and Terry understand this much better than I do. But I mean, how long does it take to really tool up and start to meet this kind of demand? I can't believe this is a problem that's going to be around for a long time. I don't know. I'm not an expert on this, but.
Yeah, I mean, you see the same thing on the supply side, and we talked about the supply side, I think, a few weeks back. You also see that in commodities. I mean, the COVID in Brazil is very untamed, and soybean, all of the other products from Brazil, sugar, prices are going high because of the supply side problems. So same thing across the spectrum.
Yeah.
It's on it's on the supply side, definitely.
Got it. Okay. Perfect. All right, guys. Terry, Bennett, you guys are quiet. You good?
Yeah, just getting some charts, some charts ready here in the background.
All right, take us away, Bennett. Get us up in the indexes.
All right, guys, let's jump into it. Hard right edge of the Motive Wave platform. Good morning once again, YouTube. Thank you guys for tuning in and joining us. So let's jump right on into it. As you guys know, we've been tracking a wave count off of the COVID lows, which does remain a little bit subjective. That said, we continue to see evidence of an impulsive trend off of the March 5th low, which I feel, regardless of the higher degree wave count, that this pattern is going to continue to materialize and produce gains on the upside. So let's take a look at it. We're starting it off with the S&P. We're on the daily chart. And as you can see, I've dropped the yellow circle on there so you can, for context, as we drop down in time frame. And we're going to take a look at off of the March 4th low. And off of the March 4th low in the S&P, you can see we're now down here on the 1 hour time frame. We had a beautiful 5-wave rally. So another 3-wave corrective pullback took you into the March 4th low. We rally in a 5-wave trend. We then see a counter trend, a 3-wave pullback. We came out, if you guys follow us on our Trading Analysis YouTube, which is a fantastic way to stay up to date. Between the shows, Terry, Alex, and myself, all three contribute content on that channel. You can go to tradinganalysis.com to find the link, or youtube.com/tradinganalysis. But back then, we were looking for continuation in the 3rd wave position. And we've seen a fairly significant rally. If I just take a percent measurement of the move off of the March 25th low, we've seen about an 8%, just shy of a 9% rally. We've been in a kind of a sideways period of consolidation, which I'm viewing in one of two ways. I currently see this as either post 4th wave inside of this orange 3rd wave. So when working a motive impulsive trend, we want to see a clear extension within one of the impulsive waves. So either the 1, 3, or 5 position. Inside of orange wave 3, which we've already met our initial price objective, which would be equality to orange 1. That came in at 41.23. You can see we surpassed that. We've yet to meet one of the more common objectives, which is the 1618. That sits up at 42.99, so just shy of 4,300. Obviously, 4,300 being a bit of a psychological price point to be considering. So I see us as post fourth wave inside of orange wave 3 on our journey up to 4250 to 4300. You'll notice, excuse me, all the good old Texas allergies. You'll notice here in the third wave position, if we were to take the subdivision of orange wave 3 and take a look at our two most common fifth wave objectives in terms of fib targets, you'll notice that we have a stacking here, which it looks like I've already got this pulled up for you guys. We have this clustering where our 61% relationship of our fifth wave compared to waves 1 and 3 happens to have confluence with, and for some reason motive wave is just going to take that fib away from me, so I do apologize. But what we have here are our two most common fifth wave targets, which include equality of 5 and 1 and a 61% relationship of the fifth wave compared to 1 and 3. That's above 4,300. So essentially you have 2 degrees of trend which are offering a cluster of fib up near 4,300. So you have 4,250, 4,300. If that were to break, you have a zone up near 4,325. Now, we are up against the 1272 retracement of this decline. And you might be asking, well, why is that important? The 1272 retracement of this decline is still a zone of resistance that we need to get through in order to see these upside targets come into the picture. The 1272 external retracement happens to be sitting at 4211. So if we take a look at the 1272 external retracement, which I have represented here with a B versus A measurement, that zone at 4211, if for some reason we were to reject that area and start to turn lower, in that case, we're going to have no choice but to view this as an ongoing fourth wave, which we would then pair up to the wave 2 pullback into the March 25th low. Even if that's the case, I see a breakout to follow that would at the very least retest the previous high, if not set a new high. So some actionable takeaways: if we can get through 4211, I'll be referring to the count that says we are on our journey towards 4,300. In the event we reject that 4211 area and start to turn lower, we have clustering of fib support between 40.5 and 4,100. Now that's the S&P. Let's quickly take a look at the Nasdaq, and then I'll pass it back over to Todd. Taking a look at the Nasdaq, we have a very similar wave structure at work. Either we are in the wave 4 position, which would pair up to the wave 2 pullback into the March 25th low, or we're actually still contained excuse me, within that third wave. That wave count would look something like this. You'll notice, very similar to the S&P, we have a post fourth wave move inside of the higher degree third wave. What I really like about the chart here in the Nasdaq is the orange third wave's 1618 price objective at 14,490 is just above the 1272 external retracement of this three-wave decline. Oftentimes, a break of the 786 brings a move to the 1272. So we have a confluence of targets between 14,372 and 14,490 for the Nasdaq. At that point, we'll be looking for the wave 4 to pair up to this wave 2, and then again, a fifth wave move to at least retest the previous high, if not set a new high. Because remember, fifth waves can be truncations. Taking a quick look at the XLK, which is the sector spider ETF for the technology sector, you've got a very similar wave structure at work here, very similar to the Nasdaq, with targets up near 145. So I continue to remain bullish. We are approaching the summer months, and obviously, as you all know, if you've been trading for any length of time, there are instances in which we see very slow, lethargic, low volume trading throughout the summer. So perhaps we see this 5-wave rally complete into the summer, see a bit of a consolidation, but ultimately I remain constructive on the long term. That's it for me. Back over to the team.
Good work there, Bennett. Actually, I'll show you a quick based on the NASDAQ count. Then I'll take the screen real quick. I'm starting to build a little NDX option fly position here based on the blue count. And And what Bennett said, based on the yellow, that is this wave 4 not quite complete? Is this move, which is a little bit clearer in the S&P? This is the Nasdaq. Is it a 3-wave move up and wave 4 is going to extend out? It's possible. So I started to put on a little option fly, and I'll show you what it is. So it's based on this. So we're looking at 1, 2, and then within orange 3, you need 5 smaller waves. So I'm looking to reach up to this like 14.2 to 14.4. Obviously, with Apple coming up here, that's going to be very important. And Microsoft was fairly muted, but here's the position I'm in right now. And I just have a little 1 lot on, and I'm going to see how the market reacts, possibly send out a full-size position to our clients. So just a little 14,000, 14.2, 14.4, 14,000, 14,200, 14,400 balanced butterflies. So on either side, I just have a 1x2x1. And you could do this in the NDX, you could do it in the mini one, you could do it in the Qs, you could do it in the XLK. It's fine. Just looking to get up to that like 14.2. So max profit would be about 16,000. Max loss would be about 3,800 just for a 1 lot. And again, I'm trying to get up to this 14.2 over the next 10 to 12 days. And that 14.2 is the upper, sort of right up into the upper fib target based on the bullish count that Bennett was showing us. So I'm going to be very cognizant of the yellow that says this is a B wave of 4 and we're going to go down. And obviously I'll have to stop myself out, and we've sent it out to clients. We'll do that. So, but I am starting to reach for the upside. And the biggest thing is, again, rates are not continuing higher yet. We do have some projections to say that this might be a pullback and rates are going to continue. We are seeing a little bit of an uptick, but we'll see. We're still pretty much under the 1.6 to 1.7 in the 10-year, and that's going to be a big impact on rates. So let's take a quick break, and then on the other side, we're coming back with Terry with Sector Focus.
Hi, if you don't know me, I'm Todd Gordon. I worked in the trading markets as a profession and a passion immediately following college 19 years ago. As I've grown older, my trading and investment style has changed. As I've grown as a trader, my holding period for my investments was also growing longer. I was learning firsthand that being properly allocated in the right stocks and sectors on a longer term time frame with proper hedges in place and the idea of compounded returns are the keys to building real long-term wealth for most of the investing community. You can short-term and swing trade the stock and options market if you like, but do so with a very small percent of your capital. And by no means should you be trading with a majority of your investable assets or your portfolio. For our clients in trading analysis, we recommend that you don't trade with any more than 20% of your portfolio in the strategies for our members at tradinganalysis.com. The rest should be managed by a professional financial planner. So last year I ventured out to make a final evolution of my career in the markets. I left the very capable team at Trading Analysis that I built to run the day-to-day operations. I set out to build a wealth management business leveraging our reputation from CNBC and our years in the financial markets. We'll be launching soon, so please keep an eye out for details. If you'd like to be updated as information becomes available, please visit www.tradinganalysis.com/investments. Again, thanks very much for your interest. Look forward to what the future holds. Cheers, and let's get back to the live stream.
Hello traders, I'm Terry Long at tradinganalysis.com here with your weekly sector focus. Like always, we're going to start with last week's performance of the index and sectors. Last week's price action was mostly a choppy trading week, ultimately ending only slightly down. The S&P just yo-yoed to end the week down 0.13%, and that same choppy behavior affected the Nasdaq 100 as well, as it ended the week down just 0.72%. Now, ultimately, bring this over here. Ultimately, this is last week's sector performance. The choppy trading week netted gains for the real estate sector, the healthcare sector, excuse me, Each of those up about 2%. And there were losses in the utility sector, consumer discretionary, and here in the energy sector, which was down 1.77%. Now, earnings reports are in full swing this week, and we do expect to see another dynamic week ahead, though it seems like investors are somewhat on pause with the waiting on to hear from the Fed today. Monday and Tuesday's price action, you can see here, these candles are very tiny, right? So very muted action. Monday only saw the S&P rise 0.18%, and the Nasdaq, though, was up 0.61. But both indexes seem to be hesitant to push through these new highs this week. Again, like I said, waiting, I think, on the Fed and key earnings reports. Now, through Tuesday, the S&P is up 0.16, and Nasdaq's only up 0.14, and futures are open kind of flat right now. But this week, so far in this flat trading, the energy and financial sectors are currently leading, with energy up about 1.89%, financials up about 1.2%. The sector laggards this week are again, utilities down 1.34, staples down 1.19, and healthcare down just about 1% here. So our leading sectors still remain unchanged, with energy, financials, communications, industrials, and materials outperforming the benchmark S&P. The leading quadrant sports 5 of these 11 sectors. But look over here, this real estate sector is positioning itself here in this improving quadrant for an attempt to push into the leading quadrant soon. Now, as expected here, the ongoing consolidation continues in the energy and the financial sectors. Nevertheless, I do have expectations that this consolidation will level off. We could see a resurgence from stocks in these sectors. And that's because they have really retained their relative strength leading positions as they've been declining, mostly vertical and not directional here. Now, the communications sector has been seen in a decline, also moving south, but again, not really losing too much of its relative strength for now. Well, the industrial sector, on the other hand, is now showing a slight heading turn to the east. So there's just a little bit of a turn there, and that is indicating it may start to gain more relative strength position, and it possibly could eclipse the XLC and find its way moving up the list to the number 3 spot, maybe even as soon as next week. Now, the materials sector continues to follow the trajectory of the industrial sector and move higher into the leading sector. And there's the materials following along where came right back up the same path that the industrials did. Now, this sector, the materials sector, has a lot of stocks demonstrating increasing momentum with improving trends, and a list of potential new leaders in this sector is strong and growing. Now, still hanging out down here in the lagging quadrant are the technology and consumer discretionary sectors. The XLK has yet to fully form a reverse hook. If I scroll back to Friday, this is from last Friday, that hook is not formed. Monday and Tuesday's price action is giving an initial indication possibly the hook starting to form here in the XLK. Again, that's only 2 days of price action out of the whole week. So we got to let that tail completely form before we'll make a decision on that. But the XLY has already had 2 weeks since it's turned its tail north. And so now we've got 1 full week there plus 2 days. And this last 2 days has got really high velocity here in consumer discretionary. So I'm liking what I'm seeing there. Now, healthcare sector also has a clear reversal hook back to the north, signaling an end of its momentum decline and another period of rising momentum at hand. However, it remains deeper in the lagging quadrant in terms of relative strength, and it's really not moving to the right, so it's not showing signs of gaining relative strength. Likewise, the utility sector is now showing rising momentum, and it has just now moved up into the improving quadrant. However, again, its relative strength gauge is even further to the left and still very weak. Now, the staples sector has pushed a little bit higher into the improving quadrant, and I am starting to get a slight northeasterly heading here, so we'll keep an eye in the future here for increasing relative strength. But at the moment, relative strength, anything, the further you get to the left here, the more underperforming the group as a whole is doing. Now, because of the real estate, this move here that I noted a couple of weeks ago, I noted here that we started getting an improving trend. The vector pointed towards the east and is continuing in that direction right now. Today's sector focus is going to be on the real estate sector. So the real estate sector is divided into 9 individual industry subgroups, as you can see here. And I have them listed in descending order. Well, let's see here. Yeah, descending order by relative strength ratio. Now, each of these industry groups holds a list of stocks representing that category. Now, normally we typically follow the stocks with the largest market caps for the increased liquidity in trading that those larger market cap stocks provide. And you normally see me just show this this list here, which is the XLRE top 30 by market cap. And so it's a smaller list than the entire real estate industry here. But one thing interesting, you can see that about half of the stocks in this XLRE are already over here in the leading quadrant. And also, there's another group over here in the improving quadrant sporting a leading trend, sporting an improving trend that are set to move into the leading quadrant soon. And this list includes Health Peak Properties, we've got Duke Realty, we've got Prologis, Crown Castle, and Realty Income here. So I'm positive on these stocks that as they're positioned, they're going to track over here into this leading quadrant as well. Now back to this industry group, which we already have over here in the leading quadrant and showing an increasing relative strength. This one here is the residential REITs, real estate investment trusts. Now, this particular group contains 13 stocks. Let's pull that one up. Here we go. It's 13 plus the index itself here. And for which you can see many of these are already over here in the leading quadrant. And those in the improving quadrant are rapidly pushing eastward also, with rising relative strength towards this leading quadrant. The only one that's seen here with a weakening trend is New York Mortgage Trust here, and moving with a weakening yellow trend down into the weakening quadrant. Let's move over here into industrial office REITs. This group I want to look at here. Let me scroll my notes here. This group is seen here in the weekly RRG, sporting an improving trend and a northeasterly heading. This group contains 27 stocks, which are broadly distributed across the RRG, mostly though in the improving and the leading quadrants. And again, there's a very nice cluster of stocks showing improving trends as indicated here by these blue vectors, and these may warrant further analysis as potential trading and or investing ideas. And these stocks that are listed here is once again Duke Realty, you got Rexford Industrial, Prologis is again in this group here. So those were also duplicated in the list of the top 30, but they're certainly here in this particular industry group. So I like those. All right, let's see. The last group that I want to show you here is this diversified group. Let's go back to let me go back to this industry list here. Let me show you that. Here's the diversified list. Here is the industrial and office REITs that I just showed you. So this industrial and office REITs is in this improving quadrant, pushing with a northeasterly vector. Also, this diversified group also has a northeasterly vector. It's a little bit weaker, but it may also contain some good opportunities here. So, the XLRE, I think, is well positioned in the improving quadrant to move over into this leading quadrant soon. And you really want to buy and hold stocks that have a relative strength greater than the benchmark if you wish to beat the S&P performance. So please take this list of ideas that I've given you, apply your own filtering systems to identify if these stocks are appropriate candidates for your trading portfolio. And, there's presently a very high demand for housing, and this market is red hot. But you need to do your diligence and not jump in blindly to just any investment, which is why we utilize the Optima platform to help us identify the best trading and investing opportunities here for our subscribers. That's all I've got now, Todd. Back to you.
Good stuff there, Terry. Yeah, that's, as you're talking, I know you've been watching the real estate market, and I think that's another indicator when you start to see dividend payers, sectors like staples and utilities and real estate start to rotate in, but the overall averages remain, market's open, but the averages remain stable and not selling off. That starts to be a little bit of a leading indicator into where yields are going. And, Bennett, I'll take the screen real quick before we flip it over to Alex and get us caught up on a little bit of macro and a lot of bit of crypto. But just looking at some of this housing's data here, let me just share the screen there. So this is U.S. housing starts over the last 60 years. I can't really draw a trend line here, but if you could get a 2-point trend line there and come across, you're looking at about, just around 2 million new housing starts would start to show resistance from the 70s before the boom. And we've seen a really nice push up there. Big COVID sell-off and a subsequent snapback, but nothing crazy about new housing starts there. This is existing houses. We have backed off there quite a bit there, from mid 6s down to low 6, and then my go-to-meeting thing is in the way there. Case-Shiller, this is home price index year over year for the 21st century. So you can see that, we actually, if you did eyeball a trend line there, it looks like we're starting to push above. So home prices are certainly moving up. Housing market looks good. We'll see what happens on the corporate side on that. But residential real estate is red hot. So interesting. And then the last chart I was going to show you, which is hidden behind my little screen here, is 30-year mortgage rates. Again, they've ticked up a little bit. We got down to like 2.25 on the 30-year, but this is over the last 40 years. We just get down to the last 6 months. You can see that we were down to 2.5 or whatever. We have moved up to about 3, backing off here a little bit. And again, the biggest correlation between 30-year mortgage rates is the 10-year U.S. Treasury yield. So watch that 10-year TNX quote. Those two are the highest correlations. So if rates start to move down, that's certainly going to be good for technology. And I also think for dividend payers, and specifically real estate and residential real estate, which is booming, and hopefully the lumber shortage can catch up. So let's get over to Alex. Let's get to the crypto corner. Don't forget, Alex is his own YouTube show tomorrow at 9 a.m. Eastern. He's doing really well. A lot of good feedback. Tons happen in crypto and specifically the alt space. So be sure to check Alex's show out on the Trading Analysis channel. And Alex, take it away, man.
Okay, so let's dive a little bit in a macro overview. Let's look DXY or the dollar index. Not much of a development there. From our 5-wave move lower, we are still kind of consolidating here. Many options from the Elliott wave perspective are possible. So I'm looking for either A down in B up in C, or WXY, or even A triangle B up in C. So, but I still think looking these propositions here regarding the wave count and the RSI, that in one point, I think maybe a few weeks down the line, dollar might start to move in this second leg on the upside. So as regards of pairing that with copper, I will just show you what I see here, what's going on the copper futures. So copper has been seeing a very big move on the upside. Pair that with what we have been talking before on the supply side. I think this is the final push on the upside. 5 waves up in 1, down in 2, up in 3, triangle in 4, and we have a little bit more on the upside left. Also, if we look some of these wave counts on the 10-year yields, we are seeing a little bit move on the upside, but still potentially we might do a little bit more pullback. It depends on the Fed today, and the big resistance is around 177 and 1.9 to 2. One that is flipped on the upside, I'm afraid we might see a little bit of upside acceleration in rates, but all of that, as I said, I think it's a short-term spanning in a year or year and a half while economy balance itself, and then the forces of technology advance pushing prices down and demographic will kick in because there are larger trends above these transitory supply side problems. So let's dive into cryptos. We have been looking Bitcoin in a consolidation. It was a doom and gloom on Friday when Bitcoin started to move down. Everybody was saying cryptos are done. I think this is a still sideways consolidation. I'm still going to stay for my view that has been already for a couple of months already. I think this is a sideways consolidation with either a triangle or a completed flat. And I see here one more move up to this 74.80K. Also, I see a lot of people are counting on this RSI on daily. Many of the technical analysts are showing that. I'm going to show you something which I see on monthly. And if you can see here, it is a bigger time frame, but we are coming to the region when we have major corrections in cryptos, and we are hitting that levels now. It's not going to happen maybe immediately, but I just want to point out that some of the things I'm looking is on the higher time frames are kind of entering dangerous zone. So my final view will be that after we post these highs and reach this 200 projection ratio, which usually we look for the green wave tree, we're going to come down either in a complex correction because the second wave was very simple, or in a big triangle for this fourth wave pullback, and then we will continue higher towards this 150, 180K, which was our primary target from beginning of this move on the upside. I can show you also one of the popular latest Dogecoins, which is Dogecoin, which is moving up in a market cap. You know everything about it already. It started as a joke, but now it's coming close to 40, 50 billion market cap. I think potentially one more move on the upside, but then I see a big move down in Doge, which will break many of these Doge, I think, enthusiasts, because 5 waves up in a third wave is potentially going to be over around these levels, and we are going to see a relatively huge correction, pairing that with our Bitcoin wave count. And I think that will be all for this edition. If you want to see more on cryptos, come to the trading analysis live show, Crypto Lab with Alex tomorrow, where I will go through a little bit more in cryptos. So back to you, Todd.
Wait, Alex, before you flip off, can you get down to a smaller time frame? I know you're probably holding this off for the members and for the show, but there's still a lot of room to go in Bitcoin, isn't there? Until we're in that wave 5 of 3. There's man. Oh God.
I mean, that's all pairs with a one more move up in a Bitcoin. So still this can kind of morph into a triangle or something, but I'm looking potentially flat. So we might kind of juggle a little bit here, but I think that the resolution will be still on the upside towards the 0.69 on 0.7 fib ratios. That usually works very fine on the Dogecoin for this third wave on the upside.
This just cracks me up. I'm sorry. I'm laughing with you. Like,
yeah,
like, this is unbelievable. This story. I mean, only 3 weeks ago did I find out it's not Doggy Coin. Now I know it's Dogecoin. Now I know Elon is like, it's like there's. Are we in a bubble? No. Tech stocks are making a ton of money, but there's these pockets of ridiculousness of liquidity. Is it the stimulus checks going into the cryptocurrency markets as 30-year-olds and 20-year-olds are working from home? I don't know. But there's pockets of insanity here, which is incredibly interesting. But it's just been the point that, like, don't let it sidetrack you from the fact that companies are making money. We're in a strong uptrend. Interest rates are mostly capped for now. Fed's not going to let it happen. But there's these sideshows that are just a riot. Like, I've been trying, Terry, to not refund my Kraken account because I have my Coinbase money where I hold my Bitcoin. But I've been thinking about refunding. I know you still have your Kraken account, so you can get in there and trade Dogecoin, right, Terry? In Kraken?
Yes. Yeah, it's listed. Mm-hmm.
And then Ethereum too, Alex.
Yeah, Todd, Dogecoin from these lows up to these projected highs will be up 58,000 times. Can you imagine that? 58,000 times. I mean, I never saw that number on the upside. Yeah, Ether is looking still pretty much good on the upside. I count this as the final sequence. As in a Bitcoin, we have been going pretty much on the upside in Ether. So we're going to meet a very nice fib cluster very soon. So I think the same with the Bitcoin. We are going to go in a massive correction soon. Reaching these levels, the wave count agrees, the ratios agrees, the RSI agrees. So as in Bitcoin, a little bit more upside, and I think it will be a little bit of kind of a crypto winter for some time until this fourth wave unfolds. And it might take time because if you can see the longitude of the second wave, fourth wave might take some time in a triangulation or a complex correction.
Yep. I mean, I would actually argue that looks more like a flat. I'll shut up in a sec. That looks like more like a flat and green too, Alex. So guideline of alternation says 4 might be sharp. You know?
Well, I don't know. I count this as a 5 waves down, flat in a B wave and a C wave down. So I more look at it as an ABC. Also in the Bitcoin, if you look. Also, this was hardly a flat because it retraced only 50%. We need flat to go a little bit higher.
That's not 50%
yeah,
of
let me see. 618.
No, it's 60. Yeah. Okay. All right. Fair.
Yeah,
Doesn't matter. But there is opportunities to short when we do make another push higher.
Yeah, as you can see here. If you can see on this one. It portrays kind of in a time relation. If we go to equality, we will be for some time in a crypto winter. So let's kind of assume we start from let's say June, July to go down. Equality will be February 16, 2022, and 1618 will be June, July 2022. So it's going to be a kind of a short 1 year, 1.5 year crypto winter here, I think.
Lovely. All right, guys, good show. Great job, TA team. Viewers, thanks so much for hanging in with us. Be sure to give that little thumbs up button a little tickle, a little smash if you don't mind. Let Google know that you appreciate this fine trading analysis team. Thanks for spending time with us, guys. Let's see. We have a little AMD earnings trade, which is doing okay here. AMD has strong earnings, amazing move in NVIDIA. We're backing off here a little bit, so I don't love. So far, guys, we're going to see what Apple does, but so far we're not seeing quite the response that we'd like to see in the averages. With Google just blowing it out. I mean, Google, $26 a share from 26.29. They were looking for 15.82 revenue. Beat forecast. It was a record profit. They also announced a $50 billion share buyback. Like, Google's doing well. We'll see. We'll see what the rest of our earnings, but so far we're not seeing the response in the indexes. So caution in the near term, but you know, I think it's more about what the Fed is doing. I think what inflation's doing, with the stimulus bill, with the fourth stimulus checks coming out and $2 trillion package coming, and Biden's talking a lot about this. So the Fed's government's behind this market. I don't see much reason to fight it for now. So. Again, thanks for watching, guys. Hope you enjoyed it. Catch Alex tomorrow at 9. Check us out at Trade Analysis. Wealth management is coming. And guys, closing thoughts, stuff that I missed?
Nope, good show. We got the Fed.
The only
this
thing I was
afternoon.
going to say was that 58,000% rise was, I think I heard someone say that eclipsed the tulips of the 1600s.
Oh, I've heard that.
So,
I've heard that, yeah.
So this,
The Holland
so this is the
tulip
biggest bubble in trading history.
It will be fun to short it.
I mean, but it's easy to call it a bubble, and I just, you know, we've had so many bubbles recently. You have the 2000 tech, you had 2006 real estate. You know, then we have supposedly we're in the bomb. Everyone's calling it a bubble, but like, look at shares of GME, and I just, you know, not to keep it going, but all right. So you had a massive short squeeze, a historic short squeeze that we talked about for decades, manifest into capital injection in the company. Now they're reinventing themselves. They're trying to restructure on the corporate. So my point is, like, the markets lead the underlying fundamentals, and maybe there is utility for these things. Maybe they're not just bubbles. I mean, we know there's going to be utility, and Bitcoin's already being traded, but why? You know, could they, with certain attention and market cap gains, could they work themselves into our daily lives? Is that possible, guys?
Yeah, actually, the underlying story is here is, I think that because Elon Musk was involved in kind of a supporting from his Twitter the Dogecoin, that it might find some utility in his ecosystem. So that's also one of the things where I think this thing is actually propping up. So there is a kind of a line of thinking that you are doing now. So there is a point that in some future blockchain ecosystem, Dogecoin can be adopted by Tesla for some or the other reason. I don't know which one, but you know, so that's also possible.
Good point. That's a good point. And then I think, you know, I was watching the Elon, listening to Tesla's earnings call, and like there was a couple things that they said that I don't think Wall Street's given Tesla enough credit for. You know, I've been long-term bullish. I've got a pretty good allocation of Tesla. I've had it forever. And also, you guys can find that on YouTube. I'm happy to say I bought the bottom in Tesla on YouTube. I did it publicly with an options trade. I didn't buy it to go long, though. I bought it to cover a short, unfortunately, but I got it like pre-split around 150, but whatever, 175. But so there's a couple things in the Tesla conference call that I thought was interesting. They were talking about, I think Elon said the Model Y, I think, is going to become the best-selling car in the world. I mean, those future growth was unbelievable. I think their energy storage is something that they're not talking about. You guys know I'm super bullish on what they're doing with SpaceX. They're not getting enough credit for what's going on SpaceX and global satellite coverage. A few other things. I didn't write them down. So it's energy. It's, the insurance business too, I think, is huge. You know, they've got more data, billions of miles driven, which is able to be injected into their AI systems. And then they can spit out a driver profile, and they can then write you a instant insurance policy for driving. already happening in California. So there's like so many different aspects to Tesla that I don't think Wall Street's giving them credit for. And I'm gonna try to up my allocation in Tesla and the money management business. I'm bullish. I've been bullish. It's kind of selling off here a little bit, and I love it. All right, so go ahead, guys. If closing thoughts. Awesome. All right, guys. Good job again. Thanks for watching, viewers. Appreciate you spending the time with us. Hopefully it's helpful. Catch Alex tomorrow. We'll see you at Trading Analysis. If not, we'll catch you next Wednesday. Alex, Terry, Bennett, great job, guys, and see you in the members webinar in 20 minutes.
Sounds good. Appreciate you guys, and we'll catch you all next week. Take care.